Hi everyone, Buyer's Agent Jay Pace here for Providence Property Group with a market update for the month that was July 2025. Now for those of you new to the channel, we are a national buyer's agency with offices in Sydney, Melbourne, Brisbane, Adelaide and Perth. We believe that there is always an opportunity somewhere turning dreams into addresses, and we help you to be a player and not a spectator in your wealth journey, focusing on quality properties over quantity. We've been operating through 3 decades. Our experience will ensure no sleepless nights worrying about property markets. And on this channel, we talk about all things property, but most importantly, I read the news and separate the facts from the fiction so you don't have to. Let's jump straight in with some data. Okay, so this here is the Hedonic Home Value Index. You'll see CoreLogic's actually being taken over by a company called Cotality. So the colors and everything are all different now, and their website's very different. Still great data, great information. #1 research company in New Zealand and Australia. So here we have every capital city recording a rise in dwelling values through the month that was, and led by Darwin with a solid 2.2% rise, followed by Perth at 0.9% there. And then third place we can see is Adelaide at 0.7%. Now, interestingly, and I've had someone ask me about this, so I just thought I'd address it because I am looking at it now, so I can't unsee it. You can see Darwin is actually the best for the month, the best for the quarter, the best for the year, and the best for the total return. Now, does that mean with this, these 4 gold medals that this is the place to be buying? 100% no. I have nothing against Adelaide and Darwin, Darwin. I'm not throwing any shade towards Darwin. They could probably use some shade. It is quite hot. But it's more just because understanding the history of Darwin, where the population is growing in Australia from net overseas migration, where the amount of employment opportunities are, etc. It's just not it. Darwin's done nothing for a very long time, and I'll show you that right now. So if we have a look here, Darwin currently at its peak, the highest it's ever been. Over the past 5 years, it's done 36.1%, which is actually not that bad. It's better than Melbourne at 15.6%. However, for the last 10 years, Darwin's increased by only 6.5%. So in my opinion, this is not an area that we're recommending our clients invest. I guarantee you are going to see some growth here, but what are the indicators as to when to get out or how long to stay in for? The data is just too volatile. So we are not playing in that game. If you want to go roll the dice, be my guest. This is the update for the month in regards to the speed check. Melbourne's weekly movement is now actually in positive territory. Now this is for the first time in over 12 months. It's a clear sign of a turnaround. I've been talking about it turning around over the last 12 months, but now I'm actually seeing the numbers in the speed check. So have a quick look here. We can see Adelaide, median dwelling value, $843,399, up $59,000 over the past 12 months, or $1,100 per week is the current speed. And yes, it's slower than what it was the month before. Brisbane, faster than it was the month before. Median dwelling value now, $934,623, currently up $68,000 for the last 12 months, or $1,300 for the last 52 weeks. Melbourne, again, now for the first time up, in positive territory, might I say. It's actually up $80 per week. $4,000 for the past 12 months. Currently, median dwelling value is $803,000. Perth, $831,000, let's call it $832,000, up $54,000 for the past 12 months, or $1,100 per week, tying with Adelaide. And then finally, we've got Sydney there, median dwelling value, $1.228 million, up $20,000 for the last 12 months, or $400 per week. Okay, this is the gross rental yields across the median dwelling values for the major capital cities. You can see combined capitals about 3.5%, and then we've got Sydney at the lowest there, out of the capitals at 3%, followed by Brisbane at 3.6%, and then Adelaide and Melbourne tie at 3.7%. Perth still holding at 4.2%. So quite interesting there. Again, people focusing on trying to get a higher rental yield, and that's why those other capital cities with those above average 3.5s are certainly seeing more interest. Now I've updated the numbers based on 100% borrow, which means zero deposit. So I'm assuming if you're buying this property in this scenario, you don't have any cash, you're just doing an equity release. So let's assume you're receiving a 3.5% income on a median dwelling value of $926,854. So that means that you're getting about $32,439.89 income per annum. But we need to take away the holding cost, which is just the interest. So I'm not taking into account other holding costs like strata, insurances, maintenance, etc. I'm just focusing on the interest rate. And so currently, let's say 6.5%. I know that some people out there can get better than that, and that's fantastic, but let's just make this conservative. 6.5 means you're paying out $60,245.51 in interest. So take that away from the income you're receiving, means that the holding cost is about $27,805.62 per annum. Now, obviously, this is negatively geared, which means you're not going to pay interest on that cost that you've got there. So $27,805.62, whatever tax bracket you're on, whatever tax bracket you get back from that, that is what the actual end holding cost would be. So let's say it's going to be closer to about a $15,000 holding cost, give or take, something like that. $534 per week, or after tax, probably closer to around $300, $280 per week. Okay, I came across this, and this is dwelling approvals and total annualized dwelling approvals, and I thought it was important to share with you. This chart shows just how far the Albanese government is from reaching their Housing Accord target. And I've talked about the Housing Accord target a lot, so I'm not going to go into that, but I just wanted to show you how far away we are. The Housing Accord target for 2025 to 2029 is there, and here's currently the amount of dwelling approvals that we are at. Very, very far away. This also is a good chart just showing the current residential vacancy rate. So as everybody knows, vacancy is the amount of properties that are kind of available. Now we can see here that the vacancy rate has had just a really big downturn since the beginning of COVID in 2020, and it really hasn't recovered since. And this is why when you take into account the fact that our vacancy rate is at record lows, the amount of dwelling approvals we're doing are at record lows, and the immigration levels that we have are at record highs, one could only assume that that makes for a very bad ratio of supply and demand, and that's only going to push property prices up. Okay, I'm going to do something a little bit different today. I thought I would do a quick rundown of each of the major capital cities, just in regards to its performance and what it's been doing. So I'll quickly go through this, and I can expand on this if you want to have a chat with me on the phone. So here we've got the key market data. Dwelling value in Sydney, about $1.21 million. And then you can see over the past 12 months, it's up by 1.3%. Yield currently, the rental yield is about 3.1%. Vacancy rate is about 1.3%. And the New South Wales population year on year is up about 1.3%. Now, top reasons to invest in Sydney, okay? Because I'm not one of those guys that only likes one or two particular capital cities. There's lots of reasons to buy, and there's lots of reasons not to buy. Really, it comes down to your personal risk tolerance level and the goal that you're trying to achieve. So let's look at it from an economic perspective. Nation's largest diversified economy, absolutely. New South Wales improving on home loans and retail momentum. That's from mid-2025. So all this data, by the way, is from things like the State of the States State of the States report from CommSec, SQM's report, the Pulse report, CoreLogic's data. So I just kind of take that, crunch all that, and figure out what's the most outstanding stuff. In regards to infrastructure, because infrastructure creates the most employment, and employment is the catalyst for the most amount of population growth, and population growth affects supply and demand. So Western Sydney's International WSI Airport, so $5.3 billion, that's opening in 2026. Runway is complete, and they're in their testing phases currently right now. Sydney Metro West, the CBD to Parramatta, multi-$25 billion project that they've got there. They've got tunnelling and everything like that. That's 90% complete. August 2025, everything should be done there. Supply and demand. New South Wales approvals are up in June to up to that June 25 period, but still below the longer run, and we definitely need to see listings go up. They're very tight at the moment, but as they are basically with the whole of the nation. Rental market vacancy rate 1.3%, very tight, but so is everywhere else. Unit yields, obviously units are getting higher rental yields than houses. That's just the way it is in every single capital city. So units are actually getting about 4% compared to the 3% that houses are receiving. But then you've got to figure, well, what's the capital growth difference there, and make that decision for yourself. Population, solid growth led by net overseas migration. Interstate migration is negative, but overall there's net growth stable, and that's from overseas people really coming into our country. Pros, unmatched liquidity, global demand, mega projects. Cons, lowest house yields in the country, high entry price points, which mean not only deposits but also stamp duties, etc. Big project delivery planning is basically putting everything at risk, because if something doesn't happen and people are banking on that, how's that going to affect the market? So now let's look at Melbourne. Market dwelling values show that they're about $797, let's call it $800,000. 12-month growth is actually down 0.4%. Rental yields at 3.7, vacancy rate 1.5, and the Victorian population is increasing 1.9% year on year. Now, top reasons to invest, focusing on infrastructure first. Metro, the tunnel there, $15 to $16 billion. That opens now, 2025. Testing is already underway for that. They've got the Northeast Link, $26.2 billion. That completes in 2028. Supply and demand, unit pipeline aids affordability. So, there are more units that are being built there. Detached supply is certainly constrained amid build costs. So people building, freehold house and land, that's obviously going up. Approvals, pulse still lumpy. So that's obviously a bit of an issue. Rental markets, well, the vacancy rates are at 1.5, which again is still good. Unit yields above Sydney from 4% to 4.9% in Melbourne. So the unit yields are actually quite attractive. If you put down a 20-25% deposit on there, you're close to positively geared. So that's quite attractive for a lot of people that just want to see a bit of a set and forget. Population is strong. Net overseas migration is underpinning demand. And the data that we've looked at over the past couple of years now shows that Melbourne will have the largest amount of net overseas migration. So certainly something that's going to help that out. Looking at economic depth, large diversified economy, mid-pack with solid retail momentum. Pros, high population growth 2025 to 2028 and beyond. Transport uplift, relative value compared to Sydney. The difference in price point is quite high, with Melbourne now basically being the cheapest capital city out of the top 5 to buy in. Cons, softer recent growth. And here's the big thing, guys. Policy, land tax, levy settings, just the way the government runs things down there. The Victorian government has the highest amount of debt in Australia. Okay, and the way that they plan things is insane. I saw that they just spent $13 million in regards to taxpayer money on bins for people to deposit their machetes. Just crazy stuff like that. Doesn't mean I wouldn't buy there. I am buying there. I'm just about to buy something there now, actually. But what I'm saying is that those things need to get taken care of before we see a market go up. And the reason I'm buying there is because even though it looks bad at the moment, I'm pretty sure it can't last forever. So I'm going to get in while it is bad. Now, cons, as I said, softer recent growth and risks again on mega projects. Next, let's look at Brisbane. Okay, so market dwelling value about $926,000. 12-month performance up 7%, so that's pretty good. Rental yields 3.7%, vacancy rate 0.9%, very tight there in Brisbane. Queensland population up 1.1% year on year. Economic depth. So let's have a look at strong on housing finance and labour momentum, upper tier. That would have been upper tier from ComSec State of the States report in 2025 standards. Then we've got infrastructure. Brisbane Metro, $1.55 to $1.7 billion services commenced in 2025. Cross River Rail, $17 billion. Timeline now towards 2029, probably blow out to 2032 in my opinion. Supply and demand, infill constrained. Obviously, they just don't have a lot of space for people to build in the Brisbane area. You're going to have to go further out, starting to go regional, which we do not recommend. Olympics, decade supports a long-run demand. We'll see how the Olympics actually does change that market there, because they often take money from the local governments to make sure that they put it into a better Olympic event, and that can definitely affect the way that the market moves there. Rentals market, vacancy rate, like I said, 0.9%. Unit yields, 4.5%, pretty good. offering good cash flow. Population, like I said, 1.9% up year on year. Net overseas migration is a plus, positive interstate flows also. So people are leaving other capital cities to move to Brisbane for a lot of reasons, I would imagine. Pros, strong migration, tight rental yields, improving transport network. Cons, basically the completion of these projects, like I said, they're one of the big red flags here because you just don't know. The insurance based on the climate, floods and things like that can be an issue. Entry yields are compressing with price gains. So as prices go up, obviously the return that you're receiving from a rental perspective is going down. Let's look at Perth here. Perth, so dwelling values, 820, 12-month performance up 7%, very good. Yields 4.3%, vacancy rate 0.6, very tight. Population up 2.4% year on year, very high. So that's very good. Economic depth, top state on Comsec's rankings for that State of the States report. Strong retail, housing, finance and equipment spend. Infrastructure, so they got the MetroNet Thorn Line to Cockburn link, and that's opened on the 9th of June 2025. MetroNet Byford Rail extension, that opens on the 13th of October this year. Supply demand, limited for sale stock. It probably has the lowest amount of stock in Australia in regards to a capital city. Strong demand still. Population surge is the key driver there. Rental market vacancy rate, like I said, probably one of the lowest in Australia at 0.6%. And unit yields are 5 to 6%. So really easy to get something that with 10-20% deposit that's going to be positively geared in Perth if you're looking at buying a unit in a cracker of a location. Population up 2.4% year on year, fastest of all the states. So let's look at the pros here. Best growth plus yields combo, big mobility, uplift from the MetroNet. Cons, resource cycle exposure. When they're talking about cyclical exposure here, they are talking about mining because that is the main driver of employment in WA, and obviously depending on where that is in the cycle, it can go down. Build sector capacity, they can't build enough properties there fast enough, so that's obviously an issue as well. And quick price rises, we are seeing them still moving up quite quickly, narrowing the value pocket there, so it might become unaffordable sooner or later. Last one here is Adelaide. So looking at that, 837, 12 is the median dwelling value, 12-month performance, 8%, yield 3.7, vacancy rate 0.6, and then we've got our population up 1.1% year on year. Economic depth, we can see number 2 nationally in Comsec's rankings, strong construction pulse. You've got infrastructure, north to south corridor, the T2D is a $15.4 billion project due 2031. There's a new women's and children's hospital, $3.2 billion. That's under construction already, and it should be done by early 2030. Supply and demand, modest new supply, owner-occupier demand keeps pressure on the entry-level stock. And if we look at rental market, the vacancy rate is still very low, very tight. Steady yields, population 1.1 year on year. Again, that's strong. Pros, consistent growth, tight rentals, diversified economy. Cons, small liquidity, light market, long dated corridor works, and yields below Perth. If it was between this and Perth, I'd still be going Perth. That's me personally. I still just think Perth has more to offer in that respect, and also more to go in regards to the capital growth. All right, let's just have a look at the RBA cash rate. Everyone got excited when the RBA announced its third cash rate cut for 2025 with 25 basis points cut, bringing it down to 3.6%. And that announcement comes after inflation continues to ease. What happens when interest rates drop? Money becomes more easily available for people to borrow. What does that mean? That means when someone's going to bid on a property, they might have an extra $25, $30, $50, $100,000 to spend, and they're more likely to spend that. So that actually just means typically that prices go up when interest rates go down. All right, let me show you, by wrapping this up, just a few of the recent purchases that we've done over the past couple months now. Let's go into that. So this first one's Melbourne. I actually grabbed 2 Melbourne ones. I substituted it for a Sydney one just because we have been doing a lot in Melbourne and I'm getting a lot of questions about it. In a nutshell, this is a tidy property on a large block with development potential. Not much more to say. Long-term tenant, they want to stay on, they're keeping the house really nice and clean. I mean, so because they want to stay on means that they're loving it as their own house, and that's probably one of the reasons why it was so clean and tidy when my buyer's agent went in to check it out. Nice wide street frontage, easy side access, really helps with that that potential development side of things. It's 18 kilometres west of Melbourne CBD, $610,000 purchase price. We're getting rent of $450 a week, which is about 3.83% gross rental yield. Why do we love this purchase? Well, I already kind of said it before. The tenant is staying on board. It's currently zoned for 4 levels. So you could build up by 4 levels on this particular property. It's also walking distance to the train station, which is only 23 minutes into the CBD. This is another Melbourne property, large 600 square metre block with development potential. This is in a totally different direction to the last one I just showed you. Internals were renovated to breathe some life into the old gal, and it definitely looks a lot more attractive. I will say this, to be 100% honest, this product is not owner-occupier appealing. When I say that is that you'd have to do a much bigger renovation to turn this into a full owner-occupier style property, but the previous owners did just enough of a renovation for it to go, like you can see the brand new windows and stuff like that. They've done enough to make this attractive that tenants will stay in here for a very long time. But this is a property that you want to hold on to because one day you're going to sell this to someone who wants to develop it, or you're going to develop it yourself. All right. So low maintenance for the longer term hold. You can see again, updated lighting. They've got downlights in there now near the chandelier, and you've also got updated aircon and heating, which is also a big plus. New rear entertainment deck. It's got a large garage and storage area there. I thought it was a granny flat originally. It could definitely be turned into that, or a secondary dwelling, or like a what they call a teenager's retreat. But it's definitely quite large, and you can see it here on the. Actually, my big head's in the way. You can see it here on the floor plan. The garage is quite decent, 4 by 6, and then right behind this, you've actually got a separate space for the storage area as well, which is quite large. So 36 kilometres south of Melbourne CBD, and some people might go 36 k's. That's a bit far south. Now the Mornington Peninsula and those areas to the south are actually some of the more expensive areas of Melbourne. Geography in every capital city is quite different. So this is actually quite a good buy. $780,000 rental estimate, about $560 a week, or 3.73% gross rental yield. Why do we love the purchase? 605 square meters. It's a GRZ1 location in regards to the zoning, which is excellent zoning with a 20 meter frontage. So this thing is ripe to be turned into a duplex site, or maybe have two different dwellings on there, maybe a battle axe style site with 2 freestanding homes. The house has recently been renovated. It's just a good investment property. Now let's have a look at Perth. So we got this set and forget for an investment client in North Perth. And nice internals, low maintenance. It's in a family-friendly location. Very, very good property. Again, the client just wanted something that was easy, low maintenance. There's no grass to be mowed, no nothing. It's a 225 square meter block, so it's not a small block, but it's not a big block. Rear lane access, which I always love, as you know, and double garage or double car space is what it has as well. It's all paved. Again, low maintenance. It just makes sense. So 38 kilometres north of Perth CBD, we bought it for $635,000. Rental estimate $630 to $650. So that's a 5.2% rental yield. That is a very attractive rental yield for a house. All right. Why do we love this purchase? Low maintenance, rent ready, property in a coastal suburb. It ticks all the boxes. Let's have a look now at Brisbane. We purchased this fully detached and freestanding townhome in a boutique complex of 4. This property has high 2.7 meter ceilings, polished 600 by 600 porcelain tiles, open plan, living and dining area. It's very lovely. It is quite a nice. This is an owner-occupier appealing townie, absolutely. Master bedroom has a split aircon unit in it, walk-in wardrobes, there's a study nook, it's sleek, the ensuite's really nice. It's a nice product, okay? And even from the facade on the outside, it doesn't look like your typical townhouse project. Also as well, it has a bit of a dog leg after you go in, so it's just not straight, they're on top of each other type of townhouses. And also, we purchased this one with the street-facing front here on the left-hand side. And that's kind of what you wanted. So that's 7 k's from Brisbane CBD. It's 6 k's from the airport. This home's ideally situated within walking distance to the train station and bus services, local shops and dining options. So again, it just really made sense for our client. Layout's attractive too, actually. So 8 k's from the CBD, $1,030,000. We're going to get a rental income of about $760,000, which is about 3.8%. Why do we love the property? freestanding modern townhome with a double lock-up garage with direct street frontage in a boutique 4-townhouse complex that's in a nice elevated position with the inner city suburb of it's just great. Like, we really are quite happy with this property. Okay, well, that's pretty much it. So remember that we can't help you until you commit, and once you commit, we won't let you fail. We're bringing two things together here: your desire to build wealth and our nearly 20 years, nearly 20 years now of experience buying properties. So for the more than 3 decades, Providence has helped Australians open up a life of opportunity through real estate, giving them the future that they want. And we buy unique quality assets in areas where demand outpaces supply. And we focus on properties that appeal to a much larger market of owner-occupiers. And we buy in the right capital cities at the right time, guided by economic property cycles. So if you have any questions, want to get in touch with us, please reach out. Until next time, have a great day.